So my name's Danny Cohen, as I said. Just to take you through some of the housekeeping for today. We're going to have 3 panelists speaking at the launch of this first Altron FinTech short-term credit impact index, which is going to be called the AFSCI, which is a little less of a mouthful than the full name of the index, we hope. Our 3 speakers that we have today are, sorry, won't somebody just put themselves on mute? Thanks. Mteto Nyati, who's the CEO of the Altron Group, Johan Galatli, who's the MD of Altron FinTech, and an independent economist, Keith Lockwood, who's also an adjunct lecturer at Gibbs and who actually prepared the index on behalf of Altron FinTech. We're going to start with Mteto and then move on to Johan and then to Keith to take us through the findings of the index. After those presentations, we'll go to a Q&A, and journalists are welcome to put their questions in the chat group or just to put your hand up and you can put your question directly. We're trying to keep this as informal as possible. I know some of it's quite technical, so please feel free to ask as many questions as you like. Keith is a very, very experienced lecturer and well versed in how to explain difficult concepts. I know he was very helpful to us in explaining how the index actually works and the impact of it. My partner, Sandra, will also post in the group a copy of a press release, Keith's presentation, and Keith's full report. And these will also be uploaded onto the Altron FinTech website, and there will be a link to that website where all the material's waiting. And we hope to wrap up everything in an hour because we know you're all busy. So thank you for joining us, and I'd like to hand over to Mteto.
Thank you so much, Danny, for those words and for welcoming everybody. I also would like to echo you and welcome all of the journalists who have chosen to attend this great launch of ours today. I'm not going to be long. This is not my space. This is really Keith's space. But I want to really position why we are doing what we are doing. From an Altron perspective, we have a very clear purpose or a mission in life. Our mission is to deliver innovation that matters. So basically by that, we mean that we would like to use technology to address and make a difference in terms of the society in which we're living in. And in doing so, we have identified 3 key areas where we would like to make a positive impact. The first one is the healthcare management. If you are in South Africa, you will understand why we have chosen that space. There's so much that is challenged in that area, both in the public and the private sector. We're providing some key solutions in that area to make sure that we continue to have a world-class healthcare in our country. The other area that we focus on in terms of societal impact is safety and security. You may know some of our products there as in Netstar. We are living in a country that is challenged when it comes to security, when it comes to crime. We have decided to do something about it. The third area of focus, which is why we are here today, is the financial inclusion. We feel that our country certainly needs to continue to be growing in order for us to address the big challenges that we have, in particular the challenges around high unemployment. But to do that, you need economic activity. You need as many people as possible to participate within that economic activity. And financial inclusion is that important key element. And this is where we also felt that as a company, we can add a contribution. And it is in this area that we are today announcing this AFSCI Index. We have chosen, as many people who focus on innovation, we have chosen to work with others We know that we do not always have all the answers within Altron. Here we've partnered with Keith, who is going to be sharing with us. We're excited about the results that he has come up with. We're excited about this index and what it will do for the industry and what it will do for our country. So with those few words, welcome once again. And I just want to hand back to you, Danny. Oh, Johan.
That's fine. Thank you so much. Thanks, Mteto. Appreciate it. Johan, would you like to share a few thoughts with the media before we hand over to Keith? Johan, you're on mute.
There we go.
There we go.
Thank you, Danny. Thank you, Mteto, and thank you, Danny. And welcome to all the media. This is a marvelous opportunity for us, and I'm really excited about this new index. For those of you who don't know Altron FinTech is a division of the JSE-listed Altron Group. We provide secure payment and collection technology solutions to the financial services industry. Today, we'll be sharing the results of the first Altron FinTech Short-Term Credit Impact Index with you. It will be known as the AFSCI, and we'll be updating the index quarterly. The first index, launched in August, is called the AFRI, the Altron FinTech Household Financial Resilience Index. The AFRI interrogates the financial state of the households by assessing the state of credit extension from the perspective of the ability of borrowers to repay loans. If you missed the report and press release we shared in August, please let us know in the chat box and we will send it to you. Today we are launching the second index, the AFSCI, which tracks the impact of short-term credit on the economy, jobs, and the collection of taxes. We are pleased to have partnered with leading economist and adjunct faculty member of the Gordon Institute of Business Science, Keith Lockwood, who has compiled the AFSCI and will present his findings to you today. As we all know, credit is an important cog in our economic engine that fuels economic growth. An increase in the credit extension injects money that was previously out of circulation back into the economy and thereby generates an adjacent stream of contributing economic activity and incomes. Altron FinTech commissioned the AFSCI with a view to assist our credit providers in the short-term credit market in their assessment of credit extension risk and in building a deeper understanding of the contributing role that this form of credit plays in the South African economy and society. Short-term credit is a relatively poorly understood form of credit, despite the critical role that it plays in contributing to the growth of the fragile South African economy. While short-term credit makes up a relatively small share of the total consumer credit, it is of vital importance. It provides first-time access to credit to many people that have never had access. It provides lower-income households with a proportionately greater share of credit than is advanced to them by other forms of credit providers. It provides a source of funding to households with low incomes and limited wealth assets in the event of unforeseen emergencies. It provides finance to micro businesses for working capital, inventory, or asset purchases. And finally, it provides a barometer of the financial health of a vulnerable and often neglected portion of South Africa's informal economic active population. We hope you will find this presentation of the first AFSCI as interesting and insightful as we have. I would now like to hand you over to Keith Lockwood. Thank you.
Yes, thank you, and good morning to everyone. I think Mteto's introduction was important, and especially in the context of financial inclusion. Although short-term credit extension actually, as Johan said, makes up a very small portion of the total credit that's extended in the country, it's nevertheless proportionately a much more important and relevant source of credit for low-income households. And I think that's part of the reason why we've particularly chosen to focus on this particular segment of the market. I think as a consequence, it's also, as Johannes said, relatively poorly understood. It's not often studied in great detail. And it's in that context that, that we're going to proceed. Now, since this is the first launch of this index, I think it is appropriate that we spend a little bit of time unpacking how we actually went about constructing this. So I've got a presentation set up and I will work through that. In future editions, we might not have to do all this background stuff, but I think at the launch, it is appropriate. All right, so I'm just going to launch a presentation now. All right, hopefully you can all see that clearly. Okay, so I think just by way of introduction, it's a good idea to go back to some fundamentals. Some of these points have been made, but I think they are worth reiterating. All right, so the first point is that access to credit allows borrowers to bring forward purchases and to make investments in assets and income generating activities that they would otherwise be unable to afford. So in that sense, it's an important point. And as was the point that was made earlier, savings of households and businesses, and when it did happen, government, are a leakage from the circular flow of income. So money is taken out of circulation. A critical role of financial intermediaries is to put that money back into circulation. Credit extension is a very important component of that. The World Bank has identified access to credit as a critical part of financial inclusion. And it's especially important for small, young and growing firms, and to poorer households that have limited financial and wealth assets, so that in the event of unforeseen developments, such as the kind of disruptions we've seen as a consequence of the COVID pandemic, they have some access to funds that will help see them through these unforeseen events. As has been pointed out, when you have an expansion of credit extension, then that injects additional spending into the economy, and that supports higher sales. And as we will see later, higher sales in one business inevitably give rise to higher sales in other businesses. They generate incomes for households of both labor remuneration incomes, but also interest, rent, and profit incomes. And when those incomes are spent, that injects additional sales in other sectors of the economy that might have absolutely nothing to do with the first area of spending. The key issue here, though, is that ultimately credit extension and repayment is a redistribution of income from savers to borrowers and back again when the income is repaid, or sorry, when the loans are repaid. So the key economic impact of credit extension really depends on what is that money that's being borrowed, what is it being used for? And it makes a big difference to the economy if those borrowings are used to fund activities that are going to generate additional incomes in the future. So business activities would be different to household consumption activity. There's also going to be a difference if what's being purchased is imported, then that means money is going to flow out of the country and it's not going to be able to stimulate local economic activity. But in situations where you're spending on locally produced products, there's a whole sort of multiplier effect that comes into play. I think it's important, and especially in the context of this particular form of credit, to just acknowledge that when credit providers are approached by a borrower for a loan, there's what we call an information asymmetry in place. And sometimes that can be the result of just borrowers or potential borrowers failing to disclose all relevant information that would affect the assessment of their risk of defaulting. But in some cases, that can also just be a function of the uncertainties of the economic environment that we live in. But I think it is important in this context to just recognize that credit providers faced with this information asymmetry typically adopt one or a combination of these four approaches to limiting their credit risk. So in the first instance, they reduce the term of the loan in order to try and limit the time horizon in which unforeseen events can occur. Okay, so you would have heard of payday lending. That would be one version or form of short-term credit extension. And in this instance, you're lending money for a very short period of time in the hope that the employment conditions and other factors affecting that particular borrower are not going to change fundamentally. The second approach you would adopt is to reduce the value of the loan in order to limit your potential for loss in the event of default. Okay, so we'll often see in this space that sometimes gets referred to as micro lending, that you get very small value loans that are advanced. And then generally as the borrower builds up some sort of credit history and record, so both the term of the loan and the value of the loan can be extended because there's less of this information asymmetry and less potential for loss. Okay, the other component of this kind of lending, obviously, or risk management, is you increase the cost of the loan. Now that occurs in a couple of ways, and sometimes when you see the annual percentage rates associated with short-term lending, they appear very high, and that's in part because the administrative costs of managing a short-term loan are not hugely different from much larger values. So if you're borrowing 500 Rand and the cost, the administrative cost of assessing the risk and managing the repayment is 50 Rand, then that translates into a high percentage, but in value terms, it's not huge. Okay, and then the last element available for risk mitigation really is just to share information or threaten to do so if borrowers default. So you're sharing information with other credit providers, and in that process, you're reducing that information asymmetry. Okay, so that's an important starting point, I think. If we just look at the composition of consumer credit. Now, the figures for the first quarter of 2021, there's somewhat of a lag from the National Credit Regulator in releasing this data. But there might be slightly less of a lag between now and when the second quarter data is released. But if we look at the stock of credit at the end of the first quarter, then you see that mortgages made up about just over 51% of 2.04 trillion rands worth of consumer credit that had been advanced. So that was what was still on the books of the credit providers. And because that's a stock concept, essentially it means that whatever you started the period with, plus any new loans that you advanced, less any loan repayments or loans written off, plus any interest that was accrued on the debt, that will be your closing balance or closing stock value at the end of the period. So in this context, we see mortgages at about 51%, secured credit 22% odd, credit facilities and unsecured credit. And then we see that short-term credit only makes up 0.1% of this total. And part of the reason for that is that the very short term of the lending associated with short-term credit means that you make a loan at the start of a month or during the month, and at the end of the month, it's repaid. So in terms of a book value, you're back to zero, essentially. As the term of short-term credit extension has increased, and we'll unpack a little bit how that's working, we can see that the the share of new credit extended is actually quite a bit higher. So it's close to the share of short-term credit is about 15 times greater than the share of its stock of total credit advanced. Okay, so it's 1.4% of the 138.8 billion rand that was advanced in the first quarter was short-term credit. All right, so if we look at the trends in value of short-term credit extension, in terms of the debtors book, we see it reached a peak at the end of the 2015 of 3.6 billion rand. And then it's gradually trended lower. That decline was accelerated in the early stages of the COVID pandemic. So we got to a low of about 1.7, 1.8 billion rand in the second quarter of 2020. And the trend has been up slightly, but in fact, in the first quarter of this year, the total credit book was slightly lower than in the fourth quarter of last year. The graph on the right-hand side is showing us the difference between new advances of short-term credit and the amounts that are repaid or written off. So whenever you see an area where the blue line is above the orange line, effectively that means that more credit that was advanced has been paid back or written off than new credit that was advanced. And this is one of the contributing factors to the overall decline in the book value of short-term credit. There's been quite an interesting extension of term in this particular field of credit. So what we see is that at the start of 2015, what are often referred to as payday loans made up 74% of the total value of loans advanced in that quarter. Loans with a term of 2 to 3 months only made up 7%, and term of 4 to 6 months was 19%. We see that's gone through various cycles, but in the first quarter of 2021, payday loans were effectively only 37% of the value of new credit advanced, and loans with a term of 4 to 6 months made up half of the total lending. And you see that reflected in terms of a COVID impact as well, because of the graph on the right-hand side. You see the relative change in lending for different terms. So in the fourth quarter of 2019, in other words, in the pre-COVID period, you had 1 month loans of 1.16 or 17 billion rand, and that dropped by a whopping 38% over the course of this COVID period. The loans with a 2 to 3 month term dropped by 14%, and the loans with a 3 to 6 month term also dropped, but only marginally by 1%. Okay, so this is a quite an important dynamic, and I think it shows some, first of all, a responsiveness of the credit providers to the prevailing market conditions. But obviously, it's also a reflection of the fact that there are fewer credit-worthy individuals in society, and that's largely a function of the fact that we, certainly at the end of the first quarter, we're still sitting with about 1.4 million fewer people employed in the economy than we were in the pre-COVID period. All right, if we look at what's happened to the average value of the short-term loans, then you can see the relative trend. So in fact, the average value of short-term loans has risen at a faster rate than both the consumer price index. So it's risen in real terms in that context, but it's also risen faster than GDP per capita, which is a sort of rough proxy of what's happened to per capita incomes before income transfers and taxation. So in that sense, I guess it's an indicator that short-term credit providers are assessing the particular risks of this, and as this market is maturing, they've developed better information systems to assess the risk, but they've also been prepared to grant higher values of loans. Okay, so I've mentioned before that the share of short-term credit that goes to lower income households is much more significant than their share of overall credit. So the graph on the left is looking at shares of different income groups of the total credit advanced in the first quarter of 2021. And we can see that if you are in a household, in this case, it's at the individual level. So if you have an individual income of more than 15,000 Rand a month, then you have access to just under 90% of the total credit advanced or to consumers in that period. If you have less than 3,500 Rand a month in income, then you're getting 1% of the total credit advanced. And similarly, if you're in the 3,500 to 5,500 bracket, you're also getting 1%, and so it goes on. So in total, people earning less than 15,000 Rand a month are only getting 11% of the total credit advanced. But when we look at the right-hand graph, which is just focusing in on short-term credit, then we see that that picture is radically different. So individuals with income greater than 15,000 are only getting 43% of the total credit advanced in this segment, whereas those earning less than that are collectively getting 57% of the total credit. And that extends across all of the different income categories. So even in the lowest category, 3,500 Rand a month, those individuals are getting 6% of the total credit advanced. Okay, so this kind of brings us into the process of constructing and conceptualizing the index that we've constructed. But I think it's worthwhile just unpacking these multiplier effects a little bit, because as you'll see, we're using multipliers for the economy to assess and estimate what the impact of credit, short-term credit extension is on the broader economy. Okay, so if we start on the left-hand side, if you have an initial sale, then that increases the sales of the business making the sale. But in order to make that sale, that particular business needs to employ factors of production. So it employs labor, and it has capital, and it has property. And hopefully, if the business is successful, it might make some profits as well. We refer to those two, that impact there, as the initial impact of the sale. But in order to make its sale, a business also has to buy inputs from other suppliers, third-party suppliers. So those could range from paying Eskom or City Power for electricity to run your business, to paying an accountant to do your books, to paying suppliers of raw materials and intermediate inputs that you require to make your products. Each of those businesses will in turn also have to employ different factors of production. So they'll employ labor, they'll have capital and property, and hopefully they'll also be making profits if they're going to survive in the long term. And then and so collectively we refer to that as the first round impact of the sale. And then those particular suppliers also need to purchase inputs from their suppliers, and that leads to an indirect impact. And when all of these factor inputs, or incomes rather, are spent, that then generates sales in businesses that, as I indicated, might have nothing to do with the initial business where the sale was made. We call that the induced impact. So the economy-wide impact of a sale in one part of the economy effectively spreads to almost every other part of the economy when you add together the initial impact, the first round impact, the indirect impact, and the induced impact. But it's also important to recognize that this works in reverse as well, because in order to support these incomes and sales, we need a stream of sales. It's not enough for us to just have one sale. So if we suddenly find that we have a contraction in credit extension, then in effect, the multiplier effects work in reverse. And we get a overall economic impact that is a multiple of that initial contraction. Okay, so how did I go about constructing this AFSCI? The first thing we did was, that I did was to look at the debtors book for short-term credit providers. And essentially, we're looking at what is the overall value of that over time. And as you saw earlier, that book value has declined by close to 50% since its peak at the end of 2015. Then we have to apportion shares of that debtors book to different income groups. So the National Credit Regulator monitors what share of each form of credit goes to different income groups or income earning individuals, and that was ascribed then to the debtors book. And then we look at the weights in the consumer price index. So the CPI breaks up the spending patterns of individuals and households into quintiles. Well, actually, they break it up into deciles. So I aggregated that to get to the quintile levels. And in essence, what we're then saying is, okay, well, if a particular group has access, so let's say you're in the less than 3,500 Rand bracket, and according to the CPI, you spend 43% of your income on food, then we are assuming that if you access credit, you're going to use 43% of that to purchase food. Now, that is an assumption that we're making at this point because we don't have good information about the how people who are borrowing money in the short-term market are actually using that money. So we're assuming it's aligned with their normal spending patterns. But one of the things that I'm hoping will come out of this alliance and association with Altron Group is the fact that we can start to unpack and collect data that will give us a much better insight into who's borrowing money and what are they using that money for. Okay, and then the last element would then be to basically apply these multipliers to each of the different spending impacts. So because there's a particular multiplier for food, say, so if we find that the credit provision to or short-term credit provision enabled households to spend X billion more on food, then what are the multiplier effects of that? And then we do that for all of the other different categories of spending, and we then aggregate that to see what is the total spending that is effectively being supported by this form of credit extension. Okay, so in the context of the calculations, if we compare what's happened over the last year for which we have data, so from the first quarter of 2020 to the first quarter of 2021, we saw an overall contraction. But in terms of the different proportions of who was able to access that credit, again, based on National Credit Regulator data, we see that probably, people in the 0 to 3,500 Rand monthly income bracket actually earned slightly more or got slightly more credit advanced to them. In the 3,500 to 5,500 and 5,500 to 7,500 brackets, it was also marginally positive. But in the higher income brackets, we actually see there was quite a big contraction in how much money was advanced to people in those particular income groups. And that probably talks more to the employment instability than anything else, because people that were formerly employed in the economy are most likely to be in the 7,500 and up income earning brackets. So in terms of the impact on sales, we see that the total credit extension has gone from or the sales supported by short-term credit extension has gone from just under 11 billion rand at the end of 2015, and we're now all the way down to much, much lower levels. Obviously, as I indicated in terms of the multiplier effects, when you have less sales, you're also supporting less employment, and the government is also collecting less in taxes. So the next two graphs follow similar patterns because they ultimately derived from the sales value. But what it's telling us is that at the end of 2015, we had jobs that were supported by short-term credit extension of say close to 19,000, and that's literally come all the way down to about 9,700. And similarly, we can see that in the context of taxes collected, at the end of 2015, the government was collecting about 1.3 billion rand from the spending that was generated or supported by short-term credit extension, and that too has come all the way down to close to 690 million in the first quarter of 2021. Okay, so because ultimately it's the sales that determine, or the sales that are supported that determine the economic impact, the AFSCI is effectively reflecting those sales, the sales supported trends, but we've turned that into an index now. So what we see is that if we build a historical time series, we've gone from, in the first quarter of 2015, we made that our base period of 100. We saw that really rapid expansion of credit extension during the remainder of 2015. That took the index all the way up to 180. And then you can see the sort of trend downward since then. So in the pre-COVID period, we reached a peak just of about 118. In the second quarter of 2020, it dropped all the way down to 89. It recovered slightly, but in the first quarter of 2021, it was literally one index point lower than in the fourth quarter of 2020. So if we think of that in percentage terms, then relative to the fourth quarter of 2020, the index has dropped by 1.4% in the latest quarter. And on a year-on-year basis, it's 12.3% down. In terms of the sort of progress back to pre-COVID levels, we could see that in the value of short-term credit advanced is now literally 20% still 20% below what it was before COVID made an appearance. And in terms of the number of loans advanced, it's actually even worse than that. It's 25% below where it was in before COVID. Okay, so I think that's all I need to present to you, but I'm happy to take on any questions that you might have. Thanks.
Thanks, Keith. That was fantastic. We've got one question that was sent through to us, which is from someone who also attended the launch of the AFRI in August. And the question is, now that we looked at the AFRI and the AFSCI, what is the message for the overall economy and also for credit providers? So maybe Keith can share some thoughts, but I'm sure Mteto and Johan would like to jump in on this as well.
Okay, well, I'll kick it off, but I think this is an area where people in the industry are certainly going to have be able to make some contribution. So I think the critical thing to note about the AFRI is it's looking at the overall affordability of credit to households in general, whereas the AFSCI is focusing on a small segment of that, but a segment that is particularly important because it's reflecting to a much more magnified scale what lower income households have access to and how they're behaving. So I think the most important point that I could raise here would be that the number of loans being advanced to the short-term credit market has dropped quite dramatically over this COVID period. And I think that points to the fact that credit providers in this market are especially aware and sensitive to the fact that the incomes that would support repayment have evaporated to a large extent. So this is the particularly vulnerable segment of the population that if it wasn't for income transfers from government, probably would be much worse. But because there's been this massive reduction in total employment, this segment is vulnerable, probably more than other forms of credit extension. This type of credit extension is much more inclined to take account not just of formal income, but of informal income as well. So the credit providers are happy to consider applications for loans, not just based on a payslip, but based on demonstrable income streams, whether they be formally earned or otherwise. Other forms of credit are going to be looking much more at what's happened to people's to formal income. And so if people have lost jobs in one field, but others have been re-employed and their incomes have risen, then those credit providers will be taking that on board to a greater extent. So I think the nuance of this market points to the vulnerability of many of the lenders here. And that in part is reflected in both the fact that the credit providers have pulled in their horns a little bit, and they have reduced the number of loans they're making. In compensation for that, though, they have tried to extend the term of the loans to make them more affordable, and they're also increasing the value of the loans to make them probably more manageable and meaningful in this context.
Thanks very much. Keith, Johan, do you want to add something to this question?
If I understood the question correctly, they would like to understand how we connect it to indexes and the impact of both indexes.
Correct.
And then the message that we want to get across. So the first index really measures the resilience and the responsible nature of the people that make use of this credit. And that's the AFRI. And that index is important for us to measure and to give an indication to the people that set policy and that set regulation. So that the portion and the segment of our customers really come across by virtue of the index's results, that they're very resilient and responsible in how they manage this type of credit. So that was the first measurement that we would like to convey to our customers, and then to our customers' customers, and then the policy setters and regulators. What Keith has done for us is giving us an indication of the impact that this type of credit has on our South African economy, and that impact is important for us to measure as well, because then possibly we could influence how the policy setters and the regulation setters are trying to regulate this market, and perhaps we can give a form of measurement, because there's no form of measurement in the informal sector in our country, because all the stats and all the data that we get is from the NCR and some other notable sources. So So there's no measurement from Stats SA on what the informal sector's contribution to the economy is. And it's our opinion that the informal sector's contribution is enormous. And the customers that we have that extend this type of credit, they've got a personal relationship with the person who applies for this credit. And they take into their risk model the informal sources of revenue when they extend this credit. So for us, these two measurements are crucial and key to assist our customers and the policy setting bodies in the country, so that there is another set of formal measurements that we could actually make some decisions on. And to talk to Teto's point earlier on is that, and this is a small contribution that we could make with our societal strategic strategies for financial inclusion, and perhaps we can set some different policies to actually grow this portion and acknowledge this portion of credit extension in the market.
Has anybody, thank you very much, Johan. Has anybody else got any questions? I just want to reiterate that Sandra has posted all the relevant material in the chat group, and I've also put the link to the website where you can download all the material. And we'll also be recording the session, and we'll send it through to everybody after the session. Johan, just a question that follows up from the one that was sent through to us earlier. Could you maybe just chat a little bit more about your customers and who they are in South Africa?
Oh, we're predominantly a technology and an innovation company that supplies our products and services into the financial sector of business in South Africa. And particularly here, we provide our intellectual property to assist them, the short-term credit providers, in managing their businesses. And how do we do that? We deploy our applications in the branches or in the companies where it allows them to manage their businesses. And the point I would like to get across here is that our customers are all registered with the NCR, and we've got a responsibility here to make sure that the people who contribute in this market must be registered with the NCR. So we make sure then that when they onboard their customers, our customers, that they comply with the regulations of credit extension that the NCR has legislated. We do all the affordability studies with our software. Obviously, it's our customer that needs to do that. We do the credit bureau inquiries, and then once we have assessed that with our customers, they make an assessment of what credit can be extended, and it's their credit that they're extending to the customers. We then have our own intellectual property then that we deploy, where we collect these monies at the set dates that they've agreed to repay their loans. So our solutions also allow for our customers to do electronic funds transfers to repay their loans, or they can actually walk into a branch and pay and repay their loans with cash. So there's electronic mechanisms and cash mechanisms. So that's in a nutshell what we do, Danny, for our customers.
Thanks very much. A follow-up question I've got is: do you think that short-term credit providers should be loosening up on credit for this market?
That's always the chicken and egg situation. What our customers often do is they take their trends from the repayment and the successful repayments of credit that is extending in the market. So we measure that on a monthly basis for each of our customers. So i.e. we measure total credit extended, the number of loans, and what's the percentage of successful collecting on the said agreement on those dates that they've agreed to. And the market is currently commanding anything between an 85 to close to a 90% successful collection on credit that is extended. So our customers have really, run scared in the COVID era, and Keith's data this morning supports our experience as well. And we're close to, but not quite close to, where we were pre-March 2019. So our customers are detuning their filters, and they are extending more credit in the market. And what we perhaps should mention at this juncture is that the money that's made available for this credit comes from people and our customers. They can't go borrow money to start these businesses. This is their savings, a portion of some of the family savings, and this is how these businesses start. So it's a high risk business, and Keith alluded to that in his presentation, that the cost of extending this credit is sometimes frowned upon, but for good reason, because there's a high risk of not being able to collect. And we see that in our stats. So there's about a 10% deficit on the monthly corrections that we're trying to see how we can up that percentage for our customers. But that's always a challenge. Yes, Danny, they are loosening up, but if there's not enough funds, which is their inventory, then they can't increase the market segment. And that's what the message that we're trying to give through to our government. Let's work like under other countries, and let's see how we can increase this SME informal sector market with this type of short-term credits.
Thank you. Teto, would you like to add to that?
No. I think Johan has done a great job there. I wanted to ask a question to Keith. When I look at it, appears as if the value of the loans have gone up as we're coming down in terms of the index. So I think we're sitting now at about 94. It looks like the value has come up, and the term is becoming longer. But looking deeper in terms of the numbers, could this not be because what you refer to as payday loans have reduced significantly? It appears as if the average has gone up, but it's because of the lower portion has gone down so much by about 38%, I think. That's what you indicated.
Yes. So I think that's a very good observation. The data clearly indicates that the payday loans, or loans with a term of up to 1 month, have shown the largest contraction. And clearly that would be a function of the fact that you have a reduction in employment. So there's probably quite a high correlation between the people that have lost their jobs under this COVID period and the people who are making use of payday lending in many cases. And that talks to the sort of real economic crisis we have in South Africa in terms of the unemployment rate and who's affected, and ultimately what that means in terms of poverty. So I think it's quite important that we reflect on how we can grow this market. Johan has indicated that it is ultimately based on what is the capital base for available for on lending, and what are the sources of that capital, and then it's also linked to the risk that's associated with this particular market. So the one thing that is encouraging, and Johan pointed to the repayments or the collection rates that they have, but the NCR also collects data on what proportion of loans are essentially overdue. That is covered in more detail in the study that was made available to you. But it's very clear that actually the short-term credit providers have done quite a good job of getting back to almost pre-COVID levels in the context of who's in good standing for loans. So, and actually relative to unsecured lending, which is typically for larger loans and longer terms, there's actually fewer people that are in arrears by sort of more than 30 days in relation to the short-term credit providers. Now, again, that might be linked just to the fact that the providers have pulled in their horns, particularly in relation to payday lending. So if you only borrow for a month, then and that level of borrowing is contracted dramatically, then it means that there are going to be fewer people that are probably behind in terms of those repayments. But in the context of longer term lending, the 2 to 4 months and 4 to 6 month ranges, it seems the data certainly suggests that the levels of collections are actually quite good. And that talks to quite effective risk assessments that I think the industry is involved in. And so that might point again to how well Johan and Altron's technologies actually support the activities of the sector.
Thank you.
Thank you. Okay, it's almost up to our hour, so I'm just going to ask whether Keith, Mteto, and Johan would like to add any short closing remarks, and then we will close the session. Just to remind you, you've got Sandra's and my contact details if you would like to set up interviews. You should have the press release, you should have the report, you should have the presentation. Can I go to Mteto? Have you got any closing remarks to add?
Thank you, Danny. Look, for me, I really like to say thank you to Keith for the partnership. This is an area, when we look at our economy, we just cannot afford to continue to have an economy that is moving in this negative direction all the time. We need to pull all of the levers that we can, that are in our control. This area where there is shortage of information, and now we're able to provide information that could then help us to stimulate the economy, is something that we should continue to do. And Keith, the partnership has provided us with that. So I really like to thank him for that.
Thanks, Mteto. Johan?
Thank you. First of all, Danny and Sandra, thank you for hosting, facilitating, and setting up the session. Marvelous, marvelous job. And to my team for all the back office work that you've done to getting us to this point. And then Keith, if it wasn't for you that did all the technical hard yards for us in producing this measurement, thank you for that, Keith. And then thank you for the media editing. It's really up to them now to disseminate our information. And thank you for attending. I really appreciate that.
Thank you. Keith, I'm going to leave the last word up to you.
Well, thank you. So first of all, again, thanks to Altron, Mteto, and Johan, and everyone I've engaged with. Thanks. I think this is a good area to focus on. I think it's a really important and long overdue field that has been, as I indicated, not studied as much as it should have been. And I think that this provides us with a good opportunity. And as I indicated, I'm looking forward to utilizing this partnership to try and go dig a little bit deeper into who are we lending to and what is that money being used for, because that will enable us to start unpacking that sort of broader economic impact of spending in a much more nuanced and intelligent way. And I think it will be to the benefit of the short-term credit providing industry, but also more to policymakers as well, because I think once they understand this market better and how the money is used and who's accessing it, they'll start to recognize how important it is. So I look forward to a good partnership with Altron FinTech, and I also am quite happy to engage with the media to clarify any questions they might have or explore any angles they might be wanting to explore in any greater detail. Thanks a lot.
Okay.
Thank you very much. And thanks to all of you. You know where to find us. Thank you very much for joining us. I'm going to close the meeting now.